Hello and welcome to the Forex YouTube channel. I'm back again with a brand new video and I'm sure you are going to enjoy this one. If you are seeing my channel for the first time, please smash the subscribe button, show some love, drop your like, share this video with your friends, and if you are a returning subscriber, thank you very much for supporting the growth of this channel. In today's video, I'm going to be talking about market structure, but I'm going to be focusing more on how you can use internal and external liquidity to mark out your structure. I know you've probably watched some structure videos on my channel before, but this is like an updated video because you agree with me that as we progress as traders, the market teaches us new things and we learn new things as we go on that would improve us as a trader and will improve our performance as traders. So looking at my screen, you will see a schematics, and this schematics is just trying to imitate the price action that you might find on your chart when you pull up your chart. And if I ask some traders to mark out this structure in front of me, they might mark this as a break of structure, this as a break of structure, this as a change of character. Then they expect the market to break this structure to continue the downtrend in this manner. But the market fails to do that. Instead, broke this high again, and after breaking the high, they mark this again as a break of structure, this as a break of structure, and the same thing happens again. The market breaks this low, and they mark this as a change of character, and they expect the market, to probably react from something here and continue dropping to the downside. But it fails to happen, and because it fails to happen, it might affect their trading performance. It might impact them negatively as traders. And I'm not saying you won't take losses as traders. You will, but take losses only when you have done due diligence and you have done what you believe to be the right thing. Looking at this structure, what do we have? We have a low, we have a high. And you must have it at the back of your mind that before you mark a high or a low in the market, there must be a reason why you want to mark that high or why you want to mark that low. And the reason is liquidity. Without liquidity, you cannot mark structure. At least as a smart money trader, you need liquidity to mark out structure. So if I'm marking, let me adjust this. If I'm marking this low as my low, if I'm marking this low as my low, there has to be a reason why I'm marking this low as my low. I don't just mark this as my low, mark this as my high, and mark that as my break of structure. There must be a reason why. We have a low here. We have a low right here. We have the low, and we have our high right here. So this is our trading range. I know a lot of you have questions. Why did you use this low? Why not this high instead of this and all that? So we broke a previous high to the left. And after we broke the previous high to the left, we can't mark this as our high because this high did not take out any liquidity. Remember I said before you mark a high or a low in the market, you need liquidity to be in play. This high did not take out any liquidity. So the market created this high, created a low, and pushed to the upside. So this high now took out this low, which was a liquidity. Remember, every high and low in the market is a liquidity point. The only question is just which liquidity point are we taking next? You have to know which liquidity point or anticipate which liquidity point we are taking next. Because every high and low in the market would eventually get taken sooner or later. So this low is our liquidity point, and until this high takes out this low, we cannot mark this high as our high. So because this high took out the previous low, that is why we have this high as our high. So we have our trading range from this low to this high. So this low that is between this trading range is what we call the internal liquidity. Internal liquidity. All right. So we have this range low and we have this range high. So whatever low, because the market is moving up, whatever low you have between this range is called the internal liquidity. The top of the range and the bottom of the range is what we call our external liquidity. External liquidity. All right. So those are our external liquidity. You can see now that the market is a game of liquidity. The market created a low here, created an internal liquidity, created a high, and after creating the high, that high was marked, or that high was recognized because the high took out internal liquidity. And after taking out internal liquidity, look at what we had again. We had the market come to take out external liquidity. So that is how the liquidity game is being played on a daily basis. So because this low now, this is the lowest point that was responsible for the taking out of this external liquidity, then we mark this as our low. And after we took out the external liquidity, this is not our high. The reason why this is not our high is because this high did not take out any low. Had it been this high took out this low, we could safely mark this high, but this high did not take out the low. It created another high, and that also did not take out any low until we got to this point. Let me move this. Until we got to this point, and it was at this point that we had a move that actually took out a low to the left. And as a matter of fact, it took out two lows to the left. And for some people, they might take this as a trendline liquidity, which is also still valid. But the main thing is we want to see liquidity being taken to the left. And remember, I said when we have a range, we have identified this as our range. And what made us identify this was because we took out something to the left. So whatever we take out, whatever low that is formed between this range is what we call our internal liquidity. So as you can see, obviously, all these lows are our internal liquidity. So, and as you can see, price took out just two of them and pushed again to the upside. So you can see now that when we are in an uptrend, we want to see the market take out what? Internal liquidity lows and external liquidity highs. That is what we want to see. So as complex as this structure looks, we just have this low, this high. We have this as our low. We have this as our high, our higher low, our higher high, our higher low, and then our higher high. And we continue doing the same thing. And why do we mark this low as our low? We mark this as our low because it took out liquidity. Remember, I told you that before you mark out any low or high, you want to see liquidity being taken. So this low was responsible for taking out this external liquidity. So let me annotate that, and we'll look at it in the chart shortly. So, these were examples. I like to mark out my, you can use whatever you want. But sometimes I like to mark mine as this, like this. Liquidity. All right. So, or you can even decide to mark it as a trendline liquidity. But the main thing is you want to see liquidity being taken. You want to see liquidity being taken because it is after liquidity is taken that you see significant moves in the market, because a lot of people were already buying, obviously, from this low here. Like I said previously, some people mark this as a break of structure, and because they mark this as a break of structure, they expect the market to come. Maybe there is another block here, they buy from here, which is good, at least for them. If they fail to take profit at this high and are probably still holding or at break even, the market just comes back to take people that have their stop losses here, and here the market comes back to take them out. And after taking them out, those are sold from here, and now their stop losses here, the market comes to take them away. So this is just an example of internal and external liquidity. So you can see that the top of the ranges or the bottom of the ranges are our external liquidity, and whatever happens between our trading range or whatever low or high, depending on what direction the market is going in, is referred to as our internal liquidity. Looking at the chart now, what can we see? we can see that the market has created a trading range. And how do we know this is our trading range? Why do we have this high marked as our high, and why do we have this low marked as our low? So the low is marked as our low because this low was responsible for taking out this external liquidity. And after we take out the external liquidity, this was what we had. We had this. So we saw the market create what? We saw the market create internal liquidity points. All right. So as you can see, after we took out external liquidity, this high did not take out any internal liquidity. The same thing with this high. This high did not take out this previous low, which is our internal liquidity. It didn't take it out. So up until this point, it was at this point that we had a previous low taken out, which was our internal liquidity. So because at that point we had this high take out the internal liquidity, this becomes our high of the range. All right, so we have created a new range. This is external liquidity. This low is our external liquidity. This high is our external liquidity. This lows in between that range is our internal liquidity. So now we have taken out internal liquidity. And what liquidity are we taking out next? We are taking out external liquidity. So now we have taken out external liquidity. What next do we expect? We expect the market to take out what? Internal liquidity now. So we had something like this. We had this. We had this. So we had these two internal liquidity points. We had these two internal liquidity points, right? So now the market comes back from this high to take out this internal liquidity points. And after we take out the internal liquidity points, we can expect the market now to take out external liquidity. So you can see it's a cycle. We are taking out internal liquidity, then taking out external liquidity. And after taking out this external liquidity, what do we have? We had the price do something like this. Right? All right. So where is our internal liquidity point? This right here is our internal liquidity point. So we can see that after we took out this external liquidity, the market came back down to take out this internal liquidity. And after taking out the internal liquidity, what do we have? We had the market take out what now? The external liquidity, just like we have here. So that is how to use internal and external liquidity to mark out your structure. So in an uptrend, necessarily you want to see the market take out internal liquidity at lows and external liquidity at the highs. And the reverse is the case if it were to be in a downtrend. In a downtrend, you want to see the market take out internal liquidity at highs and external liquidity at lows. So let me know if you enjoyed this video, and let me know if you have any question. You can drop your question in the comment section. And remember, if you are not subscribed to this channel, kindly smash the subscribe button so that I can put out more videos like this, and hopefully they will help you get to the next level as a trader. So bye for now. See you in the next video. Bye.